The resolution is adopted. Without objection, a motion to reconsider is laid on the table. The unfinished business is a vote on adoption of House Resolution 359, on which the yeas and nays were ordered. The clerk will report the title of the resolution.
House Calendar Number 57, House Resolution 358, Resolution providing for consideration of the bill, H.R. 1315, to amend the Dodd-Frank Wall Street Reform and Consumer Protection Act to strengthen the review authority of the Financial Stability Oversight Council of regulations issued by the Bureau of Consumer Financial Protection and for other purposes.
The question is on adoption of the resolution. Members will record their votes by electronic device. This is a 5-minute vote.
This vote on the rules that will guide debate on the bill that makes changes to the Consumer Financial Protection Bureau. The rule calls for an hour of debate and 11 amendments, which would begin after this vote. The new consumer agency opened its doors today. This measure would replace the director of the Bureau with a 5-member commission. It would also delay the transfer of certain consumer protections to the agency and make it easier for other federal regulators to block the Bureau from issuing regulations. Today marks the 1-year anniversary of the enactment of the Dodd-Frank Financial Regulations Act, which created this new Consumer Bureau. We talk with David Clark of Reuters about it.
David Clark from Reuters. He covers, amongst other things, the banking industry for that news organization. A year ago, and even before that, we kept on hearing the term Dodd-Frank thrown around as far as legislation was concerned. Just as a point of reminder, for folks, what was the purpose?
Well, the legislation was enacted in response to the financial crisis of 2007 to 2009. Which obviously led to a lot of bailouts of banks and other, AIG. So this was essentially the Obama administration and the Democrats in Congress' response to that crisis. It's intended to prevent a future crisis or make it less likely, and also to prevent future bailouts. Of course, there's a lot of controversy over whether that's what will happen, but that was the purpose of the law.
Controversy because?
Well, one of the big issues is, the idea of whether or not banks and other financial firms are too big to fail, meaning the government, if they are about to topple, will step in with taxpayer funds to bail them out. Proponents of the law and the regulators say the law specifically prevents this from happening. There's a lot of skepticism about that, both in the financial markets and from Republicans on Capitol Hill. They're arguing that if you look at what's happened to banks since the law was enacted, some of the biggest banks have actually gotten bigger. And they're, the idea, if you look at the credit rating agencies, which assess banks' creditworthiness, they actually have said they're not convinced that the government won't ultimately step in and bail out a bank if it's going, a large bank, if it's about to fail. Like I said, the supporters of the law say, well, the law specifically prohibits that, so it's a false argument.
So when the legislation was put into effect, could you generally talk about the avenues it took to try to prevent these things from happening again?
Sure. I mean, it's a huge law. There's a lot of different parts to it. But when we talk about too big to fail, one of the specific things that's in the law is, well, what does the government do with a financial institution if it is about to fail? So what they put in the law is what they call resolution authority, which basically allows the government to seize the firm and liquidate it in what they hope will be an orderly way. The intent would be to prevent the type of chaos that happened in financial markets when Lehman Brothers failed. So the law gives the FDIC, the Federal Deposit Insurance Corporation, the ability to take over this bank or another large financial firm and basically sell it off in parts. They say wind it down, and it's supposed to be a more stable way of letting this bank or large financial company fail, as opposed to just having it go through the bankruptcy process, which may not move as quickly.
And it's not been used yet to date?
No, it has not.
As we stand today upon the year anniversary, in a general sense, how much of the law has been put into place, or at least enacted in a working fashion?
Well, there's still a lot more to be done. So, for instance, there's different counts on how many rules are in the law. One law firm that tracks this, David Polk, has said there's about 400 rules, and they estimate at this time about 12% of those have been finally enacted. So when you look at the sort of big issues in the law and what's been done, the resolution authority or the liquidation authority I mentioned, the FDIC has put out that rule. So they've laid out, well, here's how this process would work. Here's how we would wind down these big companies. There's still a lot of other aspects of the law that have not been finalized. Some of the keys there are oversight of the derivatives market. The Commodity Futures Trading Commission has put out a lot of proposed rules, but they haven't finalized them. There's also the issue of what additional oversight the Federal Reserve should have over very large banks and other financial companies that the government has decided are too big to fail, or their failure would really hurt the financial markets. Later this summer, they're supposed to put out rules as to what additional oversight they're going to perform on these firms. That'll be things like tougher capital standards, so they have a bigger cushion in case there's a financial shock and they're not, they'll have enough money to survive it. They're also going to be doing additional, what they call stress tests on these firms to see how vulnerable they are to a financial shock, but they still haven't laid out how they're going to do that. So those are things that are coming up and that have not been completed.
Up next, more debate on the bill that would make changes to the Consumer Protection Bureau as called for in the Dodd-Frank Financial Regulations Law. Earlier today, the Senate Banking Committee talked about the implications of the Dodd-Frank legislation 1 year later. You can see that in our overnight programming here on C-SPAN, also right now at cspan.org.
Mr. Bacchus. Mr. Bacchus votes aye.
On this vote, the yeas are 2.
Mr. Rowe of Tennessee. Mr. Rowe of Tennessee votes aye.
On this vote, the ayes are 238, the nays are 177, and the resolution is adopted. Without objection, a motion to reconsider is laid on the table. For what purpose does the gentlewoman from West Virginia rise?
Okay. I'm gonna speak.
Mr. Speaker, I ask unanimous consent that all members may have 5 legislative...
Lady will suspend. The House will be in order.
I think I'll just divide my time in 2.
The House will be in order. Gentlelady from West Virginia.
Mr. Speaker, I ask unanimous consent that all members may have 5 legislative days within which to revise and extend their remarks on H.R. 1315 and to insert extraneous material thereon.
Without objection.
Pursuant to House Resolution 358 and Rule 18, the Chair declares the House... Oh, that's you, not me.
Pursuant to House Resolution 358, in Rule 18, the Chair declares the House and the Committee of the Whole House on the State of the Union for consideration of H.R. 1315. The Chair appoints the gentleman from Texas, Mr. Poe, to preside over the Committee of the Whole.
The House is in the Committee of the Whole House on the State of the Union for consideration of H.R. 1315, which the clerk will report by title.
A bill to amend the Dodd-Frank Wall Street Reform and Consumer Protection Act to strengthen the review authority of the Financial Stability Oversight Council of regulations issued by the Bureau of Consumer Financial Protection.
Pursuant to the rule, the bill is considered read the first time. The gentlewoman from West Virginia, Ms. Capito, and the gentleman from Massachusetts, Mr. Frank, will each control 30 minutes. House will come to order. The committee will come to order. The committee will come to order. Members will take their conversations off the floor. The chair recognizes the gentlewoman from West Virginia.
Thank you, Mr. Chairman. I yield myself 4 minutes.
Without objection.
Thank you. A year ago, the President signed into law the most sweeping financial regulatory reform package in nearly a generation. The centerpiece of the Dodd-Frank Act was the creation of the Consumer Financial Protection Bureau. While there was nearly unanimous agreement that improvements were needed in the regulatory system for financial services and consumer credit, we as Republicans did not agree that the best answer was creating an entirely new bureaucracy.
Suspend. The committee will come to order. Members take their conversations off the floor. The gentlewoman from West Virginia is recognized.
No legislation is perfect, and Dodd-Frank is a law that needs to be improved and refined. The legislation before us today marks an important step in improving the structure of the Consumer Financial Protection Bureau, and I would like to thank both Chairman Baucus and Mr. Duffy for their leadership on this issue. The creation of the CFPB presents the first time in which consumer protection and safety and soundness will not be handled by the prudential financial regulators for institutions over $10 billion in assets. While we do not agree that many of the prudential regulators, while we do not disagree that many of the prudential regulators failed to uphold their responsibilities in the years leading up to the financial crisis, there is a legitimate concern in separating consumer protection from safety and soundness. This is why H.R. 1315 is a much-needed improvement to the Dodd-Frank Act. The Act gives the Financial Stability Oversight Council, known as FSOC, the ability to override a CFPB rule or regulation. However, the threshold is set so high that the threshold is so high for the FSOC to consider the overturning of a CFPB rule or regulation that in reality it will never happen. Furthermore, a two-thirds majority of the FSOC is needed to overturn the rule once the petition is filed. This simply sets the bar too high and further exacerbates the problem presented by separating consumer protection from safety and soundness. This is Mr. Duffy's bill, and it will lower the threshold for petitioning the FSOC to regulation which is subject of the petition is inconsistent with the safe and sound operations of the United States financial institutions, and will require a simple majority of the FSOC to overturn the CFPB rule. This is a critical improvement to the CFPB that will ensure that the CFPB regulations strike that balance between consumer protection and safety and soundness. Also in the print is considered two bills that the Financial Services Committee has reported favorably. The first represents an important change to the leadership structure of the CFPB that will provide greater stability in leadership and moderation and in rulemaking. As we've seen over the last 9 months, the current leadership structure provided for the CFPB is subject to toxic political fights. Individuals and groups from across the political spectrum have advocated for whom they believe to be the ideal candidate, and in some cases the only acceptable candidate. This is not good for consumers, and it's not good for the legitimacy of the agency. Rather than a single director, we are advocating for a 5-person commission. This strengthens the leadership of the CFPB in 2 ways. First, a commission provides greater stability in the leadership. We're all aware of the challenges in the Senate's ability to approve nominees. A commission where the individual commissioners' terms are staggered will provide greater stability by ensuring there is always some form of leadership at the CFPB. A commission will also provide greater consistency, not only in rulemaking but also in administration. I fear that a single director will set up a situation in which the leadership of the CFPB will be subject to the variances in ideology from one administration to another for whoever is appointing the director. Consumers stand to lose the most if we have a situation in which the directorship of the CFPB swings back and forth between the extremes of the political spectrum. And finally, the H.R. 1315 includes legislation that I introduced to prevent the transfer of full powers to the CFPB, which should begin today, until there is a Senate-confirmed director or chairman in place. Personally, I think this is really good government. We are talking about an agency that is sailing into uncharted waters without a captain of the ship. It is irresponsible to proceed without a leader confirmed by the Senate. In conclusion, I know the creation of the CFPB is a great source of great passion, and I look forward to discussing these bills.
Gentlewoman's time has expired.
Thank you.
Gentlewoman reserves. The gentleman from Massachusetts, Mr. Frank, is recognized.
Mr. Chairman, I yield to one of the leaders in this committee, the gentleman from California, Ms. Waters, 3 minutes.
The gentlewoman from California is recognized for 3 minutes.
Thank you very much, Mr. Chairman. First, I'd like to take a moment to thank Barney Frank for his leadership in establishing one of the most important pieces of legislation that has ever happened in the Congress of the United States of America, and that is the Dodd-Frank Wall Street Reform and Consumer Protection Act of 2010 to create a Consumer Financial Protection Bureau. And I'm so pleased to have been able to serve not only on the Financial Services Committee, but on the conference committee that worked through all of the difficulty of creating this bureau to give protection to consumers that had been forgotten, had been dropped off of the regulatory agency's agenda, who had not been protected because they simply said that they had the responsibility for safety and soundness, and they didn't know much about consumer protection. They failed on both, but our consumers have been harmed. The CFPB is needed because it is very clear that our current regulatory framework inadequately protects consumers. Just look at the wrongful foreclosures on veterans, the robo-signings on foreclosure documents, the 500% interest rates on payday loans. The list of abuses go on and on and on. This bill would undermine the CFPB by creating a commission instead of a director, making it easier for the Financial Stability Oversight Council to override CFPB rules and delaying the transfer date for the CFPB until there is a director confirmed by the Senate. In short, this bill would bring us back to the days when harmful financial products and practices went unchecked and consumers paid the price in the form of high interest rates, predatory subprime mortgages, and bad credit card bills. We've seen what happens when our banking regulators are tasked with both consumer protection and bank safety and soundness responsibilities. The pro-bank, anti-consumer stance wins every time. That's why we created CFPB, to make sure the consumer voices weren't shouted down by the industry and that an independent agency is beholden to consumers and not CEOs. A strong regulator, one which focused solely on consumer safety and championed simpler disclosure and products, could have prevented the current economic crisis and the ensuing foreclosures, bankruptcies, and defaults. Preventing the CFPB from doing its work, as this bill would only hurt Americans' consumers and turn our economy upside down. I oppose this bill. Mr. Speaker and members, it is evident what was needed, and it is inconceivable that at this point in time we could have legislation that would undermine the good work of the conference committee, of the Dodd-Frank legislation that is in the best interest of all Americans, all consumers. I ask for a no vote on this bill. Thank you.
The gentlewoman from California's time has expired. The gentleman from Massachusetts reserves. The gentlewoman from West Virginia is recognized.
Thank you, Mr. Chairman. I'd like to recognize the chairman of the full committee, Mr. Backus, from Alabama, and I thank him for his leadership on this bill and many others. Mr. Backus for 6 minutes.
The gentleman from Alabama is recognized for 6 minutes.
Thank you. Thank you, Mr. Chairman. Mr. Chairman, what is this awful thing that Republicans are bringing before the Congress today. This monstrosity the Democrats have called as an attack on consumers. Well, it's a proposal that was first brought to us by our Democratic colleagues, and that was to have a bipartisan commission to protect consumers. That is what we're being attacked for today, a 5-member board. Now, all of us in this body are for consumer protection. Our voters, our constituents are all consumers, and we're all for protecting them. We're also for protecting our financial institutions and our economy, and we need a balance. So how do we achieve that? Well, the Democrats, Elizabeth Warren, who is the originator of this Consumer Protection Commission, back in 2007, proposed a Consumer Protection Product Safety Commission. In 2008, the Consumer Federation of America proposed a Financial Product Safety Commission. Senator Dick Durbin, acting on their recommendations, introduced in 2009 a Consumer Protection Commission with a director and a board. Then the then chairman of the committee in July of that year introduced a bill, a 5-member board. The Energy and Commerce Commission followed that a few months later with what? A 5-member commission. Then Senator Dodd issued his draft discussion. What did he propose? A 5-member commission, because it needed to be bipartisan. It needed to be balanced. But what was passed out of this body really after 3 nights of amendments and sessions that went all day? Well, what came about was an unaccountable czar, one person. The Dodd-Frank bill put a single director in charge, and it gave him unmitigated discretion to issue rules, to ban financial products, to determine what products would be offered. Whether you're a borrower, whether you're a lender, whether you're a consumer of financial services, or whether you offer financial services, he will determine or she will determine what those services will be and the terms of those services. So, what is wrong with that? Well, let me say this. In America, do we give one person the power to do whatever they want to regulate every product and service that we are offered, or that we can accept, or that we as a company can offer? That sounds to me like a government command and control economy, with the government making choices that we make. So for that reason, we've been attacked for proposing a 5-member bipartisan commission instead of an unaccountable czar. The pattern from my Democratic colleagues continues to be, we're going to put one person in charge of an agency, and we're going to let them make all the decisions. And there will be no real review of those decisions. People can either take it or leave it. It's up to the government. The government controls everything. Well, Mr. Speaker, I wouldn't want George Washington, I wouldn't want Abraham Lincoln, I wouldn't want Mother Teresa to have that kind of power. That, to me, is not what a democracy is about. And if you look at the person, who is he appointed by? He's appointed by the President of the United States. There's no input for Congress. Not only can he determine all these problems, but his funding, he doesn't have to come to the taxpayers or their representatives for funding. He doesn't have to come to the Congress to get funding. He's totally unaccountable. Now, Mr. Chairman, how in the world is proposing for the Consumer Financial Protection Bureau the exact same model that the FDIC is set up with, the Federal Deposit Insurance Corporation, the Securities Exchange Commission? All of these are commissions. All of them are bipartisan. They basically ensure that no one political party, one agenda, or one person will make decisions for every American every day. But that's what has been created. And the monster is not the bill that we bring forward. The monster is the bill that you've created. You took a good idea and you ruined it. You took a good idea that was all about consumer protection and you converted it into a one-man show where one person could control every financial product or every offering in America. It could ban any product. It could say to any American, you cannot enter into that financial agreement. It could say to every American, you can't make that financial decision.
Gentleman yield.
And, Mr. Chairman, that is un-American. Now, how much time do I have remaining?
The gentleman from Alabama has 30 seconds.
I will reserve my time, Mr. Chairman.
The gentleman from Alabama may not reserve. The gentlewoman from West Virginia controls the time.
I would like to reserve the balance of the time.
The gentlewoman reserves the balance of her time. The gentleman from Massachusetts, Mr. Frank, is recognized.
Well, I'm going to yield myself 2 minutes. I hadn't expected. I am really appalled at the gentleman saying it's un-American. We ought to be able to disagree more civilly than that. And the gentleman made a misstatement when he said we took a good idea and ruined it. If it was such a good idea, Mr. Chairman, I have to ask the gentleman, why was he opposed to that good idea? He's making a big deal of the fact that we switched our view after listening to people, after having hearings. We made a change. That's why you had hearings. And we decided after a lot of debate that the model of the control of the currency, a single individual appointed by the President without subject to appropriation, was a better model for the consumer agency. So does Elizabeth Warren. So does everybody else who supported it. The gentleman from Alabama said, that was a good idea and you ruined it. But the gentleman from Alabama was opposed to it when it's a good idea. The gentleman from Alabama was all of the last 2 years opposed to the notion of an independent consumer agency. So he makes a point of stressing, yes, we decided after hearings that a single individual would be better than a commission. He says, how can you make such a change? Well, he made a change that dwarfed the trajectory of ours. He went from being opposed to it to being now telling us retroactively that it was a good idea. But even then, today on television, he said, we have concerns about an agency whose sole mission is to protect consumers unless they worry about the banks as well. So the fact is, and there's one other point I would make, there are 3 parts of the bill. He took the only one he thought he could defend to talk about, because this bill would also put the bank regulators back in charge. And it would say that the part of the bill that would give us powers over the non-banks, over the payday lenders and the mortgage lenders, which their bill retards, he didn't talk about that. So I will admire his discretion. Of the 3 parts of his bill, he only talked about one. He didn't talk about putting the bank regulators, who he says are there to serve the banks, back in charge and allowing them to veto the consumer agency. And he didn't talk about their proposal to postpone until we get a Senate confirmation, which the majority in the Senate, not a majority, but the Senate minority said they won't allow to happen. They'll filibuster, so it will postpone the new powers.
The gentleman's time has expired. Gentleman reserves. Gentlewoman from West Virginia is recognized.
I'd like to yield 30 seconds to the chairman of the committee, Mr. Baucus.
The gentleman from Alabama is recognized for 30 seconds.
Thank you. Mr. Chairman, I never voted for a standalone consumer protection financial bill. I never voted against it because it was never offered. What was offered was a 2,400-page extravaganza which hires about 10,000 new federal employees to enforce rules that weren't enforced in the first place. And I have consistently said, let's enforce the rules we have and not just hire more regulators and create more rules. And as you know, we offered a bill which did have several protections. Thank you, Mr. Chairman.
The gentleman's time has expired. The gentlewoman from West Virginia reserves. The gentleman from Massachusetts
I yield myself
is recognized.
30 seconds to correct the latest misstatement. The gentleman from Alabama did, in fact, vote against this. It wasn't just voted on as a final. He appears to have forgotten we had a markup in committee just on this bill. And the gentleman from Alabama voted against a freestanding consumer agency, whether it had 5 members or not. So he says it was a good idea, which we ruined, but he voted against it. He did vote against the individual one, and the Republicans offered a substitute which took 14 officials, made them a council, gave them the power to run a hotline, and said if anything came out over the hotline, they'd send it back to those bank regulators, who he says are there to serve the banks, and they would be the ones to deal with it. I now yield 3 minutes to the gentleman from Maryland.
The gentleman from Maryland is recognized for 3 minutes. Without objection.
I thank the ranking member for yielding. Mr. Speaker, we are still feeling the effects of a crisis that largely came about because the referees who oversee the soundness of our financial system were not on the field. We took the referees off the field. As a result, millions of Americans are still out of work. But while Democrats have worked to restore proper oversight to Wall Street, Republicans want the referees off the field again. And that would put us all at risk. This legislation puts the special interests ahead of the public interest by weakening the very entity that shields responsible consumers from financial abuses. Last year, Congress passed an important Wall Street reform bill in order to prevent a job-destroying financial crisis from happening again. And one of the most crucial parts of that bill was the creation of a new Consumer Financial Protection Bureau, a watchdog that would look out for the interest of ordinary Americans who want to sign mortgages, apply for student loans, and start businesses on honest and fair terms. The Consumer Financial Protection Bureau is empowered to ensure that lenders provide clear, plain language explanation of loan terms, and to stop the kind of abuse and deceptive loan practice that helped drive our economy off a cliff. If such protections had been in place in the last decade, the odds of a crisis occurring would have been significantly less. And I want to tell my friend from Alabama, he said that there was no congressional involvement. In fact, of course, the President does appoint, but it is with the advice and consent of the Senate, so that the entire Senate, as is normal, is involved in this appointment. But the Republican legislation that we have on the floor today would make it much easier to overturn these consumer protection rules. It would make the people's watchdog far weaker at a time when they are needed more than ever. This legislation is part of the Republicans' stated goal to dismantle Wall Street reform, protecting special interests but leaving Americans unprotected from another crisis. Removing America's defenses when we have not even fully recovered from the last crisis is a new level, in my view, of irresponsibility. I urge my colleagues, think of what we have been through. Think of our responsibility to make sure it doesn't happen again. Think of our responsibility to make clear that the interests of your constituents come first, and to vote this bill down. And I yield back the balance of my time.
The gentleman from Maryland yields back his time. The gentleman from Massachusetts reserves. The gentlewoman from West Virginia is recognized.
Thank you, Mr. Chairman. I really am just amazed at the hyperbole of the dismantling and the ruining of the agency and weakening of the agency. The Bureau will go forward with all of the consumer protections that it's empowered with in the Dodd-Frank bill. The original intent was a commission. We go back to a commission. And let me just tell you, the President has had an entire year to nominate this very important person to lead this Bureau. And it wasn't until the beginning of this week, Monday, did he finally get around to it. What kind of signal does that send? At least to me it sends a signal that it really isn't all that important to have that person there, Senate confirmed, as the minority leader said, with the oversight of the United States Senate. And let's talk about the Financial Services Oversight Commission. There's 10 people on there. All right, I'm going to go through them quickly because I don't want to use too much time. Secretary of the Treasury, he's confirmed. Chairman of the Federal Reserve, Bernanke, he's confirmed. Director of the CFPB, somebody nominated 4 days ago, empty. Chairman of the FDIC, acting director. A nomination, but nobody confirmed. Controller of the currency, acting director, no one confirmed. Chairman of the NCUA, confirmed. Chairman of the SEC, confirmed. Chairman of the CFTC, confirmed. Director of the FHFA, acting director, no nominee, and he just nominated the insurance specialist. 5 of the people on this 10-person commission are not even permanently installed. No, I will not. And so I say to myself, what kind of priority is this administration putting on this marquee part of the Dodd-Frank bill? And now I'd like to yield 3 minutes to the gentleman from Texas, Mr. Hensarling, our vice chair.
The gentleman from Texas, Mr. Hensarling, is recognized for 3 minutes.
I thank the gentlelady for yielding. I thank her for her leadership on this issue. Mr. Chairman, already we know that in America we are looking at 9.2% unemployment. Since the President told us if we would pass his stimulus plan, $1 trillion, unemployment would never go beyond 8%. And now he is presiding over the longest period of high unemployment since the Great Depression. We just got the statistics. Since they've been keeping them, it now takes almost 10 full months for somebody unemployed to find a job. 1 in 7 on food stamps. The fewest new business starts in 17 years. This economy is not suffering so much from a lack of capital. It is a lack of confidence, and a lack of confidence primarily in the policies of our President and the previous Congress. Part of that lack of confidence is attributable to Dodd-Frank and this CFPB, which, yes, does have some wonderful consumer protection powers, but also has historic draconian powers to ration and ban credit, consumer credit, for families and small businesses. And yet here it is, as the gentlelady from West Virginia, the subcommittee chairman, pointed out, almost a year later, only now has the President seen fit to appoint some type of director. The lack of confidence in these policies is what is keeping jobs and capital on the sideline. It is incumbent upon us to return that confidence. So yes, to my colleagues on the other side of the aisle, this is yet again another jobs bill. We need to say, you know what? Small businesses in America, there's not going to be one czar who controls consumer credit. We're at least going to have a panel representing both primary parties in the United States. And oh, by the way, at least now, somebody will have to consider safety and soundness and what this Bureau does. I mean, the people who are telling us don't worry about it are the very same people who told us don't worry about safety and soundness when it comes to Fannie and Freddie. Come on, it's all about consumers. It's all about home ownership. Let's roll the dice. Don't worry about safety and soundness. Well, Mr. Speaker, we have to worry about safety and soundness. American small businesses are worried about safety and soundness. It is time to bring some confidence. It is time to bring some certainty so that we can get our friends, our neighbors, and our constituents back to work, because they don't want welfare checks, they want paychecks, and this is one small step we can take today to provide that certainty. I yield back the balance of my time.
The gentleman from Texas yields back his time. The gentlewoman from West Virginia reserves. The gentleman from Massachusetts is recognized.
First, I yield myself 15 seconds to say the gentleman from Texas talked about Fannie Mae and Freddie Mac, but he doesn't do anything about it. The majority has been the majority since January. The gentleman from Texas filed a big, tough bill about Fannie Mae and Freddie Mac a year ago. He has sat sweetly and quietly by while his majority has ignored it and taken no action on it. The Republicans always talk tough about Fannie Mae and Freddie Mac when they're in the minority, and then they get in the majority and they choke. I now yield 3 minutes to the gentleman from Massachusetts, a leader in fighting in particular against speculation and the abuse of derivatives.
Gentleman from Massachusetts recognized for 2 minutes.
Thank you, Mr. Chairman. I also want to thank the gentleman for yielding for his advocacy on behalf of the American consumer. The Dodd-Frank Act created the Consumer Financial Protection Bureau with the sole purpose of ensuring that financial markets work for and not against American families. It established a single director empowered with a singular mandate, which is simply to protect the consumer. This bill, H.R. 1315, seeks to weaken the CFPB on the day it opens its doors for the first time in two important ways. Firstly, it would make it more difficult for the Consumer Protection Bureau to act by replacing the director with a five-member commission. As has been shown, a single director with executive authority and who is directly responsible to the American consumer is better suited to act quickly to address problems in the consumer financial markets, and he or she will be directly accountable to Congress for the Bureau's actions. On the other hand, a five-member commission creates another bureaucracy that would be both less effective and less accountable to consumers. As a five-member commission would also, in this case, cost taxpayers an additional $71 million. To offset the cost of these commissioners and their staffs, we're being asked to use the money from a Federal Housing Administration program created to help responsible Americans who have continued to make mortgage payments refinance their underwater homes. According to Mark Fleming, the chief economist for the property research company CoreLogic, underwater mortgages are a primary factor holding back the housing market and the economy as a whole. And so instead of working to solve this problem and boost our economy, our colleagues on the other side of the aisle have decided that our money is better spent unnecessarily expanding the bureaucracy at the CFPB. H.R. 1315 would also make it much easier for the same regulators who in many cases were captured by the industries that they oversee and who fell down on the job in the lead-up to the financial crisis to now overrule the CFPB. These regulators proved that they were not capable of ensuring the soundness of the financial system while simultaneously protecting American consumers. I urge my colleagues to oppose this bill, and I yield back the balance of my time.
The gentleman yields back his time. The gentleman from Massachusetts, Mr. Frank, reserves. The gentlewoman from West Virginia is recognized.
Thank you. Mr. Chairman, can I inquire as to how much time remains on both sides?
The gentlewoman from West Virginia has 15.5 minutes.
I'd like to now...
And the gentleman from Massachusetts has 19.25 minutes.
I'd like to recognize Ms. Biggert of Illinois, a leader on our Financial Services Committee and chairman of the Housing and Insurance Subcommittee, for a minute and a half.
Gentlewoman is recognized for a minute and a half.
I thank the gentlelady for yielding. And Mr. Chairman, I rise in support of H.R. 1315, which would prevent the most visible legacy of the Dodd-Frank Act from also becoming the most costly and regrettable. Today's legislation will provide the new agency with accountable leadership, proper oversight, and a much-needed check against bad decisions. American consumers don't need more bureaucracy to stifle innovation and raise costs. We need regulators who understand that the job isn't just to layer on expensive new rules. It's about educating consumers and preserving a vibrant and competitive financial market that provides affordable and innovative options. Unfortunately, the current structure of the Bureau is subject to virtually no oversight from Congress or anyone else. And unlike other agencies, even the Consumer Product Safety Commission, on which it is modeled, it is led by a single czar who has unprecedented power. Even more dangerous, the Financial Stability Oversight Council must agree by a two-thirds majority before they can overturn a rule imposed by the CFPB, even if that rule threatens to imperil our economy or shut down a financial institution. Mr. Chairman, our common sense reform adds a few more voices to a panel that is supposed to protect all consumers, not just those favored by the political powers that be. And it creates a reasonable process to overturn bad or inconsistent decisions. Mr. Chairman, these reforms will help protect consumers and ensure that the government doesn't stand in their way. I yield back.
The gentlewoman from Illinois yields back. The gentlewoman from West Virginia reserves. The gentleman from Massachusetts is recognized.
Mr. Chairman, I'm very pleased to be joined by so many leaders on the Financial Services Committee, and I now yield to one of them, Mr. Watt, the gentleman from North Carolina, for 3 minutes.
The gentleman is recognized for 3 minutes.
Thank you, Mr. Chairman, and let me say at the outset that I was a strong supporter in our committee for the creation of the Consumer Financial Protection Bureau and remained a strong supporter of the Bureau and its mission. The reason I did that was because all of these regulators had within their authority a consumer protection initiative. Unfortunately, that consumer protection obligation was subordinate to other obligations that each of the regulators had. And so when we started talking about this, I kept saying to them, look, we need a consumer regulator that has as much authority and as least cumbersomeness as any of the other regulators. So if you're going to create a Consumer Financial Protection Bureau, don't give the other regulators authority to reverse them unless you give the Consumer Financial Protection Bureau the authority to reverse the other regulators. Now, if you think that's fair, do it both ways. This is the only agency that ended up with the other regulators, the Federal Reserve, the OCC, the FDIC, having the authority to reverse them, and we were able to restrict it to things that was in their jurisdiction if it was a systemic risk that the Consumer Financial Protection Bureau was creating by promulgating a rule or regulation. Then we thought it was fair to have them police what the Consumer Financial Protection Agency was doing. But I don't know of any reason that we would create a child of an agency to deal with consumer protection when we don't have a child of an agency dealing with other aspects of the regulation in our financial services industry. So for me, this is just about parity. Give this agency equal authority and oomph as the other agencies have. And we are not asking that the Consumer Financial Protection be able to overrule the Federal Reserve when it makes a decision. We're not asking that the Consumer Financial Protection Agency be able to overrule the OCC when it makes a determination. Neither should we be allowing those other agencies, the FDIC, the OCC, the Federal Reserve, to overrule the Consumer Financial Protection Bureau when they are not acting within their authority. I thank the gentleman for yielding the time, and I yield back.
Time has expired. The gentlelady from West Virginia.
Thank you, Mr. Chairman. I'd like to recognize the author of the bill, Mr. Duffy of Wisconsin, for 5 minutes and thank him for his hard work on this issue.
The gentleman is recognized for 5 minutes.
Thank you, Mr. Chairman. And I want to take a moment and thank Chairman Bacchus and Chairwoman Capito for their hard work on this legislation and for their drive to make sure that this bill came to the floor today. All of us in this House agree that we want consumer protections where any one of our friends or family members, our neighbors, and our constituents, when they deal with a financial institution, they're dealt with in a fair way and in a transparent way. And our reform here to the CFPB does exactly that. It advances that very same cause. I want to talk just about a couple of the components of this bill. One is we are moving this from a director to a bipartisan commission. I think it's important to note that my friends on the other side of the aisle, when they first crafted this bill, the ranking member, they included a bipartisan commission. And the President, when he talked about this bill, he was in favor of a bipartisan commission. And now all of a sudden today, as we brought this back up, they are now opposed to a bipartisan commission. I think it's important that we note that today you may have a Democrat president and you might like the recommendation for the chairman or the director of the CFPB. But if I'm going to project in the future, I'm one to guess that I bet at one point in our future there will be a Republican president, and you may not like his appointee. Let's come together. Let's not regret this moment. Let's come together and make sure we have a bipartisan commission that's going to work on the behalf of consumers, because this isn't a Republican or Democrat issue. It is truly an American issue that should be dealt with on a commission level. One other key component of our legislation is the review standard of rules that come from the CFPB. The way it is set up right now, the only way a rule can be overturned is if that we are going to have Armageddon in the financial industry. And so the only one that can have a rule overturned is a big bank on Wall Street, one who was too big to fail. The way it is currently written, you have given a voice to those people who helped cause this financial crisis. You know what? I'm not from Wall Street. I'm from small-town, rural Wisconsin. We don't have big Wall Street banks. We have small community banks, and we have credit unions. The way the current bill is written, not mine, the one that's in existence today, the current law, it doesn't give a voice to the people in my community if a rule that comes out from the CFPB is going to affect them negatively. And you know what? On Main Street, the very people who had nothing to do with the financial crisis, who haven't been given a voice, but will if my bill passes, those are the people who deal with our small business owners, with our family members, people who are looking at expanding their business, growing their business, creating jobs in our community. They rely on community banks and credit unions for loans, and they don't have a voice. I don't understand that. And then they're the same people that we look to when we want a mortgage for our home or we want a car loan. It's these people we look to, and they have been left voiceless in the current law. I will not. But my bill gives a voice to Main Street America. And I have to say, the point I don't think can be made clearer with those who support my bill. I don't have big Wall Street support for my bill, but I'll tell you what support I do have. I have the Community Bankers of Wisconsin. I have the Wisconsin Bankers Association. I have the Independent Community Bankers of America. American Bankers Association. I have the Consumer Bankers Association. All those who are about small community banks that deal with customers support this reform. We go a step further. We have the Wisconsin Credit Union League, the Credit Union National Association, and the National Association of Credit Unions. All people who didn't have any role in this financial crisis, all people in our communities who are looking out for consumers, because if they don't survive in small-town America. And they all support this reform legislation. I would encourage all of my colleagues to jump on board and support common-sense reform that is going to strengthen consumer protection and provide great oversight for a very powerful agency, and is going to hold it accountable. With that, Mr. Chairman, I yield back.
Gentleman yields back. The gentleman from Massachusetts.
I yield myself 30 seconds first to say, first of all, the gentleman made one more flat misstatement when he talked about car loans. Car loans are exempted from this. This is an example of the failure to understand what we're really talking about. Secondly, he does have Wall Street support for this bill. I think he mentioned the American Bankers Association, and this notion that the community banks aren't involved is just nonsense. As a matter of fact, the community banks are favored here because the Consumer Bureau is given the right to examine banks of $10 billion in assets or more, but it cannot examine the credit unions and the community banks. So that was a recognition that he ignores. I now yield 2 minutes to the gentleman from North Carolina who's been a leader in trying to fight for decent mortgages.
Gentleman from North Carolina is recognized for 2 minutes.
Thank you, Mr. Chairman. I also disagree with the gentleman who just spoke. The reason that all of the Republicans want to talk about whether the commission it ought to be 5 members on a commission or 1 director is that's the only part of the bill that really can be argued one way or the other. I mean, there are arguments one way or the other. I think it will be a much stronger agency if there is 1 director, but everything else in the bill really cripples this agency before it can even take hold. And I also disagree with the argument that everybody here wants to protect consumers. No, they do not. We saw what happened in the last decade. We know who was doing it. It was the most powerful industry in America, and they were making a ton of money by cheating consumers on credit cards, cheating consumers on mortgages, cheating consumers on overdraft fees, and on and on. And we've heard the same arguments about this that we heard a century ago. A century ago, when Theodore Roosevelt pushed for pure food laws, The meat packer said, do you want government to take away your right to buy meat? Do you want government to take away your freedom to buy beef from diseased animals or spoiled beef? And the American people said, yeah, that's exactly what we want. We want to know what we're getting. And Americans want to know what they're getting in financial products, too. Do they want to lose the freedom to get a subprime loan when they qualified for a prime loan? Yes, they do. Do they want to have a credit card, to know what they're getting on a credit card? Yes, they do. Do they want to know what's really in their overdraft fees? Yes, they do. They want to know that there is somebody with their interest at heart who is reading all that fine print that the bank's lawyers wrote to be better, to be good for the banks, profitable for the banks, and let the consumer have no idea what's in that little print in the legalese. Yes, they want someone, a strong agency, reading that fine print with their interest at heart and saying, no, you can't do that. You can't cheat consumers that way. That's what this agency does, and the American people want it. I yield back.
Gentleman yields back. The lady from West Virginia.
Could the chairman tell me how much time is remaining, please?
The gentlelady from West Virginia has 9.5 minutes, and the gentleman from Massachusetts has 13 3/4 minutes.
I'm going to reserve the balance of my time.
Gentlelady reserves. Gentleman from Massachusetts.
Mr. Chairman, I would just yield myself 30 seconds first to say, and I'm sorry the gentleman from West Virginia wouldn't yield to me, but there was a lot of talk about switching positions. The gentleman from West Virginia, along with every other Republican then on the committee, voted against this. She now says she wants it to go forward, so I'll take yes for an answer. I am glad that my Republican colleagues, having opposed an independent consumer agency, now, I think maybe for tactical purposes, but for whatever, are all for it. So as we go forward, I will accept their conversion. And now I will yield 2 minutes to the gentleman from New Jersey.
Gentleman from New Jersey is recognized for 2 minutes.
Thank you, Mr. Speaker. First of all, I want to thank the gentleman from Massachusetts for what all he's gone through in the last couple of years so that people understand that we do need some regulation. Now, today, my friends on the other side, and I mean that, the stock market hit its highest point since 2008. Isn't that wonderful? And yet we are at 9.2% unemployment. Well, I looked at the treasuries. They're doing very fine. They're doing well. But Main Street isn't. And that's what consumer protection is all about. Main Street. No question about it. We don't want to go back. We don't want to go back to 2007 and 2008. Why? Because the conditions that led to the mess we have now, we don't want those conditions to exist now, and that's what we've been trying to correct, particularly over the last 2 years. Now, here's the consensus, whether you are a European financial person or someone in the United States. Here's the consensus. Dodd-Frank puts us more on a level playing field. Regard to capital reserve, regards to too big to fail, regardless of what we're talking about, we are oceans ahead of our European partners and our allies in addressing these issues because we're addressing the causes of the financial meltdown in the United States and in foreign allies. And if it wasn't for the gentleman from Massachusetts and the gentleman from Connecticut at the other end of the building, we wouldn't be where we are today, and we'd be saying, let's go back. We want things to be like they were in 2007 and 2008. Well, things were not good. 30?
Gentleman is recognized for 30 seconds.
In his book by James Stewart, How False Statements Are Undermining America, he zeroes in on the Madoff situation, which became a poster child. No one else has been really brought before us. No one else has really suffered for the pain they provided to the middle class and to Main Street people. We don't want to go back. We want different rules, and regulations do have a part in it, and the person who's struggling day in and day out needs our help. They don't need it. It doesn't matter who the president nominated, you'll turn it down. It's this bureau you want to destroy. not the nominee.
Gentleman's time has expired.
I yield back.
Gentleman yields. Gentlelady from West Virginia.
Thank you, Mr. Chairman. I'd like to say, you know, today is a nice day, but we have 9.2% unemployment. It's not a day that I think that I want to keep repeating when there's so many people out of work. And with that, I would like to recognize the gentleman from Virginia, member of the Financial Services Committee, Mr. Hurt, for 1 minute.
1 minute.
I thank the gentlelady for yielding. Mr. Chairman, today I rise in support of H.R. 1315. 1 year ago today, the President signed the Dodd-Frank Act into law, a 2,300-page bill with 400 new regulatory mandates that have created an atmosphere of economic uncertainty that has stalled job growth in Virginia's 5th District and across the country. A centerpiece of this law was the formation of the Consumer Financial Protection Bureau, a massive government bureaucracy with unprecedented authority and little to no accountability. H.R. 1315 will add much-needed oversight to this far-reaching new government agency. These checks and balances will help reform CFPB to protect small community banks and credit unions, like those in Central and Southside Virginia, from unnecessary and excessive government regulations. These community financial institutions play a critical role in providing capital to our small businesses and families as we all work to get our economy back on track. At a time when far too many 5th District Virginians and Americans remain out of work, we must continue to support policies that will help restore certainty to the marketplace, grow the economy, and create jobs. I urge the body to pass this bill, and I thank the gentlelady. I yield back.
Time has expired.
My time.